How many stocks should I own? Is it 20, 30, or 100? That is one of the most liked questions in my previous video, stock market corrections, how to be on the winning side. And that is exactly what we're going to talk about today. Towards the end of this video, I'll do a portfolio update and I'll also do a Q&A as well. So if you do have any questions you'd like me to answer in a future video, just let me know in the comment section below. As usual, if you do learn something new, it will mean the world to me if you could gently smash a like button somewhere around there. And if you really enjoy what I'm doing, consider supporting the channel via Patreon, where I make some extra content and also get access to my Discord server where I'm a little bit more available. And because I happen to be a random Asian dude that popped up in your YouTube feed, no, this video is not financial advice. So without further ado, let's go. The whole idea of having more stocks in your portfolio is generally for the purpose of diversification. And it's the whole idea that when a portion of the market tanks, if you have diversification, then your portfolio shouldn't tank as much. But we don't live in a perfect world. There is such a thing as too much diversification where the winners that you have in your portfolio just don't materially impact your portfolio. And this is also where the term diversification also comes from. So the first thing we should do is actually talk about the pros and cons of having many positions versus a handful of positions. When it comes to the pros and cons of many positions, depending on how you structure the portfolio, the company specific risk and industry specific risk should be lowered. And because of that, the portfolio would have a lower volatility, which really means that it's not very often for you to feel that a portfolio will be up 40% one day and then down 60% the next day. And because of less of those huge swings, you would sleep better at night because you just have less anxiety. And there is the opportunity or the potential opportunity that towards the end of a tax year, if you have many individual positions at a loss, you can harvest those losses against your tax liability. Now, that's very dependent on the situation, and I will leave additional resources in the description if you want to read more about tax loss harvesting. When it comes to the cons, because you have many positions, it just takes more time to keep everything up to date. And depending on how big are those positions and how much you're buying and selling, there's just going to be more transaction costs. And lastly, because of these two things, it's just going to be harder to manage a portfolio with a lot of positions on top of your day job. On the other hand, when it comes to the pros and cons of having less positions, your winners will materially impact your portfolio because you only have a handful in your portfolio. So your positions tend to be a lot more concentrated. And because of that, depending on, again, how many winners you have in your portfolio, you just get a lot more bragging rights. But it will be easier to manage the portfolio because you're spending less time to keep it up to date, and you will probably get the time and the resources to read more deeply into an industry or a specific company. But the cons is that because you have concentrated positions, the volatility in the portfolio will be a lot bigger. So it is more likely in a lowered position portfolio to experience those up 40%, down 60% type swings. And if you're not prepared to deal with that kind of volatility, it's very easy to experience a lot of anxiety. And for younger investors or more junior investors, then it's easier to paper hand and make a decision that you might regret in the future. Some of the general rule of thumbs we often hear is that we need about 12 to 18 stocks to have diversification. And some academic journals will quote 80 to 100 to achieve diversification. Now, personally speaking, I don't want to manage 80 to 100 positions because I don't really know how to do that when there are so many things that you need to keep up to date with. And for me, I found that my sweet spot after experimenting is between 15 to 20. And I want to show you how I got to my magic number or my sweet spot of around 20 positions. So how I found 20 to be the sweet spot for the number of positions in my portfolio is to ask myself a series of questions to get down to a range on the number of positions that I feel comfortable with. And then I would experiment with the upper bound and the lower bound of that range to see where exactly is my sweet spot. And the first question I ask myself is, well, what exactly is my investing objective? Because the objective will determine whether my universe of stocks I get to choose from is expanded or narrowed. Right? So there is income, there is growth. Do you want both, or do you want to preserve your wealth? I'm definitely not at this stage of preserving my wealth. And for many of you who have been following my journey, I actually started out as an income investor because I was so obsessed with this idea of passive income via dividends. And as I invested in my ability to generate income, I found myself climbing the tax brackets, and eventually got to the point that I just don't think it's efficient to deploy my capital into dividend stocks where it generates dividends as cash flow, and then all of that will be taxed away because half of it will go to the tax man. So it just became more suitable for my own situation to focus on growth stocks, and also because I really enjoy the story of growth stocks, right? So that's very dependent on circumstances. The second question I ask myself is, well, what exactly are my preferences? Do I want more or less diversification? And answering some of these questions would help me understand, should I have ETFs or should I have individual positions? And another question that I didn't put here is, how big is your portfolio? Because the size of your portfolio should also help you determine whether you can have a lot of positions, or is it more wise to have a smaller number of positions? Because when you have a small portfolio and you have a lot of positions, then nothing really is going to move the needle all that much. I had to learn that the hard way, but that's something to consider as well. And then lastly, how much time do you want to spend researching? And personally for me, before I started working full-time again, I just had more than 10 hours a week that I could dedicate to researching. But now that I'm working full-time again, I just don't want to spend as much time researching. So therefore, at one point I had 25 positions, and I realized that starting full-time work again, 25 was just too much for me to keep up. And I found that when I reduced my positions a little bit, it was much easier for me to keep up with everything. And right now, I found that 20 is kind of where my sweet spot is. Now, if you want to know my entire process of how I built a bulletproof portfolio, check out this video right here. I will leave a link in the description box below. I documented my entire process. That video is a great one to watch after this one. Now, just because 20 is the sweet spot for me, it doesn't mean that it's a sweet spot for you. So instead of listening to a set of rule of thumbs, it would be better to ask yourself a series of questions, get down to a range of positions, and just go experiment and see what you're comfortable with and what you're not comfortable with. But of course, if you have a complex situation and you need professional help, then professional help seems like a pretty good idea. So before we get to a portfolio update, I want to answer some of your questions from my previous video. So with the Q&A, I'm going to start off pretty easy, but if you do have questions you'd like me to answer in a future video, just make sure you let me know in the comment section below. Or if you see any question that you like, just make sure you tap the like button so then it goes all the way to the top and I can see it. So the first question is, AJ Johnston asks, what are my views on travel stocks, especially Airbnb and Qantas? Now, travel stocks in general is not very high up on my research list, so I don't have too big of an opinion on that. But the one thing I will say is that when it comes to the stock market in general, it's forward looking. So whatever you think is going to happen to travel stocks in the next 6 months, it's probably already priced in. So if you're interested in those companies, make sure you look beyond that and see what are the growth potentials of those companies beyond that 6 to 12 month mark. So the next question is, Tony asks, great video, David. Well, shout out to you, Tony. Have I thought about some of the mining stocks? Some look pretty good. Looks like there's a few that's oversold. What are my thoughts? And I think it really depends on the mining stock. And for me, I have what I want in my portfolio. I'm not going to add any more. My priority of learning at the moment is more around enterprise software and cloud at the moment. So yeah, not too many thoughts on the mining side of things. So Alexandro asks, hey David, I'm starting to get into stock market and long-term investing. I wanted to ask, what type of education have you gone through to have a vast knowledge in regards to investing? Now, to be perfectly honest with you, my knowledge base is quite surface level with investing, right? But if you do want to know how I built up to my current level, there is a video on how to research stocks before investing, and that is my general process on how I build up my knowledge base in regards to a company. So that is a great video to watch next, and I'll also link in the description box below if you are interested. Now, Moving Gaming asks, hey David, hope you're well. What are my thoughts on using Superhero to buy US and Australian ETFs with zero commission? Now, for me currently, I don't really want to switch brokerages because I am incredibly comfortable with CMC and stake, doing US stuff on stake. So I think it's just really painful of trying different platforms or moving my portfolio between platforms. So I really don't want to move all that much at the moment. In regards to that, actually, I want to consolidate into a single platform. That'll be fantastic. Now, Vin asks, which is a big question. Thank you for your knowledge. I've learned lots about the Australian stock market from my videos. I appreciate that. And hopefully we can do the broader stock market in the future. I have a few questions for you. I am a trend following investor. Well, shout outs to him for even defining the type of investor he is. First question is, how do you research which industry will take profit in the next 1 to 2 years? For me personally, I pick industries that I'm personally very interested in, because if I'm interested, I have a very obsessive personality. So if I'm obsessed with a industry, I tend to generate an edge over time just because of how much I read up on it. Right. So for me, it's not about picking what industry, it's just what industry am I interested in. And then generally, if I'm interested in it, I get obsessed and then I tend to get better at it over time. So I don't have a straight answer to that. It's more about what you're interested in. And then the second question is, when you are observing the market, macro and micro, what factors do I consider? For the macro and micro factors, it's very dependent on the industry you are researching. But if we're talking about one factor that we need to pay attention to at all times, then I would say interest rate, because the up or down move of the interest rate will really change how accessible is credit. And depending on how accessible is credit, it's going to change evaluation, it's going to change where things are moving. So I would say that I will pay, if I had to choose just one, then I would say interest rate is by far one of the biggest factors I would consider. But I think to answer your question on this one more specifically, then it really depends on the industry. Are there any webs that supposed to track institution transactions or insider transactions? So I think Whale Wisdom is a really good website to use that tracks mostly US institution transactions. There is an Australian version of that. I just don't remember what the website is called. Yahoo Finance does have a little bit of capability on that as well. Like, those two are free. But I will leave a comment in the current video on this question once I find what the name is. Do you know any trusted organization or analysis or review about the stocks? No, I don't. I think that's why you want to do your own research, because sometimes when funds or other people release their research, sometimes it's just biased. So then you want to do your own research and come to your own conclusion for stuff like this. And shout out to you for asking a really detailed question. So Basil essentially asked, what do I think about lithium? Would it be a good hedge against a crash? Now, I don't know whether lithium will be a good hedge against a crash, but when it comes to lithium in broader generalized context, well, I like to ask the question whether lithium is in a short supply. And, normally demand supply will determine the prices of lithium, right? And if you look into the actual research, lithium is pretty abundant. It's not as in short of a supply compared to something like copper or nickel. So while everyone's obsessed about lithium this, lithium that, I would actually just let everyone else worry about this hot commodity while I go research some of the other smaller materials that goes into batteries, like for example, copper and nickel. So that's what I think about lithium at the moment. And when it comes to hedging against a downturn, I don't do that. And frankly, I don't want to get too cute or smart or think that I can time the market. I don't like to do that. I think my time is better used by investing in my ability to generate income. And that's all the questions. So let's do a portfolio update. So as of recording this video, my CMC market portfolio side of things is worth 119,000 Australian dollars. And I know that the markets have been pretty rough over the last couple of weeks, but to be honest, that's a great thing. I will feel more worried if we don't see correction for a long period of time. And the most important thing is that when I don't need to do anything, I probably won't do anything. The account currently is sitting at around 5% cash, and I'm trying to deposit more cash into the account so that I can take advantage of some of the opportunities that it has presented. With my stake portfolio, it's currently at 44,000 USD. So altogether, that'll be worth around 65,000 Australian dollars. I closed out my copper ETF position just because I'm getting ready to reallocate that money into some of my other positions, like for example, Twilio, Shopify is getting down to a range where it looks really good, and similar to Bristol Myers as well. And as usual, I'm not sponsored by Stake, but if you do want to try Stake for yourself, I've left a link in the description box below. If you survived all the way to the end, thank you. You are the real MVP. And if you did learn something new, it would mean the world to me if you could gently smash the like button somewhere around there, subscribe to my channel so that when I release future content, you'll be the first one to know. As always, Otto will always do the honors, and I'm gonna see you very, very soon.